Hello everyone, Tony is here. Today is September 14th, 2020. I'm going to talk about two stocks today. One of them is a high dividend, yet high growth stock. Another one is about to get on the market tomorrow morning. Before I get into details, the only thing I'll ask from you is please smash that ravishing like button. The first stock I'm going to talk about is Simon Property Group, ticker symbol SPG. It is the largest REITs focusing on high-end retailing in United States. Retail REITs is one of the most damaged area in COVID. Despite the excellence of SPG, its stock went from the 52-week high $163 to $67.8 today. Like Euro, let's talk about risks first and then get into the reasons why I still want to buy it. The stock price hasn't recovered much lately. The reason being, first, is the company going to issue new shares in the next few months to relieve their cash pressure? If so, the current shareholders' shares are going to get diluted. Second, SPG and Brook Property Partners together made a deal with JCPenney. JCPenney claimed bankruptcy in May. This deal could save about 70,000 jobs and over 600 shops. Also, it is to avoid too many empty spots in the shopping centers, which could trigger co-tenancy clause in other retailers' lease. Triggering this clause could allow the lease owners to renegotiate or jump out of their lease, which could lead trouble to the company. This was interpreted as a heavy burden. Third, SPG has been trying hard to withdraw the $3.6 billion purchase of Topman Centers. The court has set the trial to mid-November. Rumors are that SPG will try to get a better deal with this lawsuit. However, this long-lost fight could end up affecting both companies' financial situation, especially to the loser. Fourth, most retailers in SPG belong to the non-essential category. If COVID hits again, more restrictions will lead to another recession, very bad for any retail REITs. If majority of the lease owners went bankruptcy, SPG would face trouble in their cash flow. Last but not least, interest rate. Currently, the interest rate is 0. Low interest rate favors REITs, since they are considered to be alternates for bonds. Once the interest rate starts going up, some people may switch back to buying bonds, leading to the stock price going down. After talking about the risks, let's get more optimistic and check our opportunities. First, personally, I don't worry too much about the dilution. The company had $3.3 billion cash at the end of second quarter. They are capable of getting multiple loans under favorable terms. The liquidity is not an issue. Things have been going pretty good since the end of the second quarter. Retailers are recovering. Retail revenue has been increasing consecutively for the last 3 months. The debt was only 44%. Lots of room if they need it. Second, for SPG helping out JCPenney, I see it from a slightly different way. If you're capable of helping others out, paying a lot to save them, you yourself are not in big trouble. Third, the offline retail market didn't disappear. It's mainly the low-end shopping centers got affected by Amazon. High-end shopping centers in major cities are still in good shape. Matthew effect works well here. Remember, 7 of the 10 most valuable shopping centers in US belong to SPG. Fourth, SPG has been negotiating with Amazon to try to turn some of their space into Amazon's distribution centers. If the deal is done, SPG will be considered as industry rights, which has the most stable stock price. Of course, going to be a lot higher than current. As the government has been giving away money in helicopters, a lot of consumers are actually richer than before the pandemic. Bad news for the government debt level, but great news for retailers. The whole retail industry could revive near Christmas shopping period. At last, despite the dividend cut, SPG still offers 7.66% dividend according to today's stock price. Even with the conservative estimation, the company is going to overcome the difficulties in 2-3 years. This is a good dividend for long-term investors, even if you don't double your returns. Upon analyzing risk and opportunities, as a long-term investor, what should be a good entry price? Here's a quick summarization of the risk, opportunities, stock rating, and price range that I would buy. I won't go into details on how I rate a stock today. It will be introduced in a separate video. So if you're afraid to miss the chance in case the stock suddenly shoot up, or you just don't like to keep an eye on the prices all the time, then 65 to 70 is a pretty good entry point. A reasonable price range is $58 to $65. A dirt cheap price would be between 50 to 57. If you can get it below 50, you're just robbing it. Remember, the above price range is just what I use to guide myself. You don't have to follow my logic. Okay. Now let's get into today's second stock, Snowflake, ticker symbol SNOW. Since there's no history for this stock yet, I'll have to explain my thoughts a bit different than usual. This unicorn is about to arrive tomorrow morning. It is the investor's most exciting field software services. Not all unicorns are excellent assets, but this one definitely is. In fact, this is one of the most anticipated IPO in 2020. Although Snowflake is a tech startup company, it was built in 2012 by 3 data management tech experts. It focuses on Cloud SaaS, which is software as a service. Let's look at the opportunities first this time. The company leads in the industry. It has excellent sales mode, has great potential for growth, and also has good management. The company developed a unique data management platform, which led to quite a stir in the market. It brought up secure data sharing the first time, which gives the marketing research companies headache because they could not quantify its market chance. Secure data exchange bonds data supplier, partner, and user together. As the user number increases, there will be more and more data exchanged among all the parties. Thus, the value of the platform keeps increasing. Let's take a look at sales mode. They've been using direct sales most of the time. Customers can purchase cloud storage or computing services together or separately. Highlights here for small customer is that they can choose to pay every time they use this service instead of subscribing to it. Snowflake now provides service for over 3,000 organizations, doubling what they did last year. Over 140 organizations were on the Fortune Global list in 2019. Based on the company's 3 digits annual growth for many years, we can see that the market really favors the service they provide. Their first IPO financing in Wall Street has already got them $1.4 billion. But in the last 8 quarters, revenue and gross profit have been steadily growing. The second quarter on quarter showed an increase of over 120% in sales. Also, gross profit rate increased doubled and now it's about 50%. Comparing with competitors, the growth rate increase is definitely higher. As the new service grows, the gross profit still has room to increase. It is predicted that the company's annual income for 2020 is going to be $600 million. Some analysts gave $15 to $20 billion for the corporate valuation. Senior management owns about 15% of the company share. Not too many to be a bunker, not too little that they don't care. Looks like they're on shareholders' side. Frank Slootman was appointed the CEO of the company. He's also the chairman of the board. He was in charge of IPO for ServiceNow last year. Got lots of experience doing that. The company is fairly healthy financially. It has $800 million cash and no debt. Now the risk. The company is still operating at a loss. Research, sales, and marketing expenses are skyrocketing. Despite the consistent revenue, the company is still operating at a loss. Also, as they're getting more and more equipment, the gross profit increase will be slowing down. Second, there are some fierce competitors out there, including products from Amazon, Microsoft, and Google. Third, as discussed earlier, the purchasing mode is pay when you need, not as predictable and stable as a subscription mode. Therefore, it needs to increase investment to build a larger client group, collect more data to gain advantage in this race. The problem is, when you expand the company, the loss won't necessarily come down. Some investors might just walk away. Its IPO price range is $75 to $85. This price is really not that cheap for the company right now. But since lots of nice institutions and individual buyers have so much passion on it, there is definitely a chance to make some profit short term as well. There's no price guidance for this one since it's new, and such a hot stock like this before the IPO might just get really crazy. I will try to buy some the moment it's on the market and let it sit for long term. I hope it wouldn't rush to 150 and then comes down 30% the next day, but everything is possible. If so, I'll add some more and let it sit there. I'm not going to invest big though, otherwise my little heart is going to get shaken by it running up and down. Again, if you find this video helpful to you, please subscribe so that more people can watch it and share their experience with us. Thank you very much. See you next time.